Do you recommend debt instruments and bonds for trading? And should they be included in our portfolio? After all, it justifies the rule of diversification. I do. But you mentioned the word trading. I don't recommend trading at all. I recommend buy and hold. Or if you've already bought the stock or bond, buy and homework. And if you trade, I promise you, it's only a matter of time until you lose a lot of money. And the worst thing that can happen to anybody is they start trading and they make money right away, because it's like going to a casino. If you've been to a casino one time, you made a lot of money. Don't go back again, man. The system is rigged. You know, you cannot make money every month by trading, because every month has 20 weekdays, which means 20 trading days. And quite often you'll be fooled by randomness. You'll be right for the wrong reasons, or vice versa. And usually the reason stocks go up or down in a short amount of time is not because of the fundamentals on a certain company or treasury instrument. Usually it's because of geopolitical events outside of your control. You know, it might be saber rattling between Riyadh and Moscow regarding the price of oil. And that can have a positive or negative impact on the price of oil, which positively or negatively impacts most stocks in the world, because most stocks are based on the price of oil, at least commodity and industrial related stocks, I should say, gold being the exception. So understand that, and understand that sometimes the reason that stocks go up or down in a short amount of time is not only due to geopolitical factors outside of your control, but it's also due to the fact that a similar company in the same sector released positive or negative news. And so I really do believe in Warren Buffett's methodology when it comes to investing, which is this: the longer the view, the wiser the intention. And you got to be greedy when others are fearful, and fearful when others are greedy. Now, with respect to bonds, yeah, absolutely. I think every portfolio should have bonds in them. You know, make sure that they're A-rated or above, AAA rated, hopefully. And the way it works in bonds is it goes AAA, which is the best, AA, A, and then anything below that is triple B, whatever. Don't invest anything below A level, please. Otherwise, you get into high yield or junk bond territory, which can be kind of dangerous. And you can lose a lot of money in bonds as well. People don't realize that. You know, people think, oh, well, if I invest in U.S. government bonds, I won't lose my money. You can lose every penny. You know, if you invest in U.S. treasuries, I think you're fine, because I think the United States government and U.S. federal debt is the lowest risk investment opportunity in the world. It's all relative. But if you invest in municipal bonds, meaning Orange County, for example, in Southern California, then you lost pretty much all your money, because the OC, as a region in Southern California, declared bankruptcy a while back, and the bondholders got pretty much wiped out. So I would just make sure that the bonds are AAA rated if you can do it. Do your own research, roll up your sleeves, and understand the tax mandate as well. Because quite often when you invest in what are called municipal bonds, you don't pay taxes on them. They're tax-free. Just do your research. Do a ton of research. Read the prospectus as well. Don't ever invest in a stock or a bond without reading the investor memorandum that comes with it. You have the legal right to get it and read it. Read them first, please. You know, when it comes to ETFs or mutual funds even, you can also read the prospectus and read the fine print and really do your own research and deep research. And Warren Buffett, when he invests in a company, he invests with the understanding that the market might be closed for 10 years. Now, of course, the market won't be closed for 10 years, but that's how long-term focused he is.